Hello, and welcome to another stock analysis on Stock Market Palantir. Don't forget to subscribe and drop your comments. Now, let's go hear our analysts.
Welcome to the Stock Market Palantir. Today, we are going to talk about ZSPC, ZSPC Inc. For anyone who's been tracking this, the recent price action is something that demands a much closer look. We are talking about a company that hit this parabolic high back in February 2025. It went over $32, only to have this absolutely catastrophic collapse. It's now trading, consistently in the sub 50-cent range. The volatility is just off the charts.
And it's not just the velocity of that decline. It's the strange dynamics of its trading environment. The data consistently shows this incredibly high trading volume. And daily, you're seeing 60%, sometimes more, being executed off exchange in dark pools. This is a stock defined by some serious market friction and a really opaque transaction flow.
That friction, that is precisely the focal point here. The central question we have to tackle is whether this extreme volatility, both the spike and this current depression, is primarily a function of technical, almost engineered market dynamics that are tied to its deeply compromised capital structure.
Or, on the other hand, is the stock's current low valuation, down near 40 cents, is that now fundamentally justified by a severe, almost existential deterioration in its financial and regulatory reality. We're looking at a 38% revenue cliff and a looming NASDAQ delisting threat. So I'm going to focus on how the market is, I believe, rationally pricing in this solvency risk.
And I'm going to maintain that the sheer magnitude of ZSPC's failure and its volatility is what's mathematically impossible without the unique, fragile architecture of its capital structure. I believe the mechanics are just overpowering the operational story right now.
Well, let's start with that operational narrative, because you really can't ignore the context of this 40-cent reality. My thesis is pretty simple. While the market microstructure might explain the spectacle of that $32 spike, that was a textbook supply shock squeeze. That event is over. The current price near 40 cents is just a rational defensive market response to a very severe financial reality.
See, I think that argument really misses the incentive structure here. My position is that ZSPC is the definitive case study where structural engineering completely overrides fundamental reality, especially when that engineering creates such an extreme liquidity vacuum. The original sin here was that 1-for-75 reverse stock split back in December of 2023.
A desperate move. It was made solely to cure the NASDAQ's $4 minimum bid price requirement. It was reactive, not strategic.
But the effect of it was structural. That's the key. This drastic reverse split, it artificially manufactured an extremely low public share count. This low float created a fragile structure that was immediately susceptible to non-fundamental catalysts. It was this specific liquidity vacuum that laid the groundwork for that February 2025 parabolic move, a classic leverage-amplified supply shock squeeze, totally divorced from intrinsic value, and triggered by what was really just a tangential sympathy play involving some other AI news.
It created a temporary trading opportunity, sure, I'll give you that. But anyone who failed to get out is now staring at the balance sheet. And when we look at the Q3 2025 earnings report, we see a staggering 38% year-over-year revenue decline. That isn't friction, that's a revenue cliff. And it's driven by the end of that massive pandemic-era SSR federal stimulus money.
A 38% decline is obviously significant, but it really needs to be contextualized.
It's context for solvency. On top of that, management has to grapple with high-cost short-term debt. We're talking a $1.1 million loan with an onerous 18% implied interest rate. You just can't run a turnaround while you're diverting cash flow to service that kind of debt. But the single greatest driver of this depressed valuation, the thing that overrides any short squeeze theory, is the regulatory imperative.
The NASDAQ non-compliance notice.
Precisely. They received it on November 28th, 2025. They failed the market value of listed securities, the MVLS requirement. And this is critical because it's not about the share price anymore. It's about the total enterprise value as the market sees it. Their market cap is hovering around $15 million, and they have to reach and sustain $35 million by May 2026. This is a hard existential deadline that forces a binary outcome, recovery or delisting. The market is pricing in that high probability of failure.
I have to pause here because we can't overlook the one genuinely positive operational sign in that Q3 report, which, it suggests the business model isn't entirely broken, and that's the gross margin expansion. Their pivot towards software is actually showing some traction, with gross margin hitting 51.2%.
That 51.2% gross margin is, yes, it's validation of their product pivot, but I'd argue it's secondary. It's a mathematical footnote to the immediate threats of cash burn and that looming May 2026 deadline. I mean, you can't service high-interest debt or meet a NASDAQ mandate with gross margin. You need sufficient net revenue. The market is correctly viewing the margin success as too little, too late, given the survival clock that's ticking.
And that brings us right to the core tension, the structural legacy of the low float versus the actual meaning of that revenue collapse.
And you're suggesting the revenue collapse is secondary?
I am. Look, a 38% revenue drop in a stable, normally capitalized stock would cause a serious decline, maybe 10 or 20%. But it does not account for a 98% collapse from $32 to 40 cents. That magnitude of loss is a mathematical function of the artificially constrained supply from that 1-for-75 split, not the quarterly miss. The revenue miss gave the market a reason to sell, yes, but the low float structure provided the accelerant that turned a decline into an absolute catastrophe.
That's an interesting point, though. I would frame that acceleration a bit differently. The low float certainly amplified the initial price action during the squeeze, I agree. But the 38% contraction now dictates their ability to survive the next 6 months. That massive contraction, coupled with the need to divert revenue, $100,000 per month, to service that high-interest debt, means the company is in a pure race against its own cash burn rate.
A cash crunch imposed by reality.
Exactly. So the market isn't punishing volatility in the abstract. It is pricing in the very high probability that ZSPC will need future dilutive financing just to survive the erosion caused by that revenue contraction in the debt service. The structure may have created the $32 spectacle, but the 40-cent reality is rooted in the solvency clock and the necessity of future dilution. That is a fundamental financial crisis regardless of the share count.
But wait, looking at that financial crisis through a purely operational lens, it misses the point of the market friction. Let's pivot to interpreting the market plumbing, the dark pools, short interest, FTDs, because this data suggests external forces are defining the price discovery process.
I accept that the argument that dark pool internalization artificially suppresses the price is a compelling technical explanation. When, say, 60% of the daily buying pressure is internalized off exchange, that's demand that just vanishes from the public bid. But the cost to borrow, the CTB data, provides a really powerful counter-narrative to the manipulation thesis.
How so?
Well, short sellers are willing to pay an annualized fee of 33 to 39%. That classifies ZSPC as hard to borrow. This shows real institutional conviction. I'm just not convinced by the idea that the price is structurally suppressed, because institutional players would not accept such exorbitant fees unless they strongly believe the fundamentals, especially that severe NASDAQ risk warranty, a price decline severe enough to justify the expense. They're betting on delisting, not on friction.
I come at the CTB from a completely different angle. The fact that shorts are paying 39% is the strongest indicator of a mechanical problem, not fundamental conviction. For an aggressive trader, this high CTB creates a fundamentally asymmetrical risk-reward dynamic. It's a coiled spring.
You see the high cost as a precursor to rapid covering.
Precisely. If there is any meaningful, non-fundamental news catalyst, even a tangential AI contract or some speculative whisper, the institutional shorts paying those crushing fees will be forced to cover, and cover rapidly, just to mitigate the daily cost pressure. That trigger would initiate these violent secondary squeezes because of that thin, engineered float. They are playing a game of chicken, and the capital structure guarantees the wreck is going to be spectacular.
But the existence of that squeeze potential doesn't negate the fundamental price floor.
It suggests the floor is artificial. And what's more, we can't ignore the persistent fails to deliver, the FTDs. We saw over 62,000 shares fail to deliver in October 2025. For listeners, an FTD just means a seller promised shares they couldn't actually deliver by settlement. And that data strongly suggests chronic liquidity failures, or maybe even aggressive naked shorting attempts that are completely external to the business model of selling AR tech to schools. It points right back to friction in the market's plumbing system, where supply is being artificially manufactured or restricted.
While FTDs are certainly concerning signs of market dysfunction, the reality is the calendar clock is ticking, and a failure to deliver shares is secondary to the failure to deliver revenue. The single most critical fact here remains that existential threat, the NASDAQ compliance deadline in May 2026.
And that is a harsh, non-negotiable regulatory risk.
Absolutely. The company's market cap right now is $15 million. To cure the MVLS deficiency, it needs to get to and sustain $35 million. That means the stock has to more than double to about $1.20 and hold that level for 10 consecutive days. This is pure, unadulterated fundamental and regulatory pressure that no amount of microstructure analysis can just wish away. If they fail, institutional investors are often forced by their mandates to liquidate positions in a delisted security. That is the definition of terminal risk, and the market is pricing that in right now.
That's a compelling argument, but have you considered the nature of the solution to this binary, fundamental threat? If the stock fails to recover organically, which, let's be honest, is highly likely given the revenue contraction, management's most probable cure options are exclusively corporate actions.
Dilutive financing or another reverse split.
Correct. Either massive dilutive financing to inject cash and maybe raise the market cap, or, critically, another reverse stock split 2.0. A second reverse split, while it might technically solve the NASDAQ listing issue by consolidating shares, it would be viewed disastrously by the market.
It signals management desperation.
It reinforces the fundamental fragility. The key takeaway is that the fundamental problem, delisting due to low MVLS, will likely be solved via a blunt, manipulative corporate action. This brings the focus right back to engineering, not stable operations. The structure dictated the squeeze, and the structure will likely dictate the cure, trapping the company in this vicious cycle of capital engineering.
And I see that not as proof of mechanical supremacy, but as management using a mechanical fix to patch a fundamental wound. I mean, they only need a reverse split 2.0 because the revenue collapsed by 38% and they couldn't service their debt. The necessity for the split is rooted in financial weakness, regardless of the share mechanics that result from it.
It's the interaction that matters, though. The fundamental weakness creates the need for the split, and then the resulting split creates the next round of structural volatility. It's a vicious feedback loop.
Which means we are both looking at the same dire reality, but we're just prioritizing different inputs for what the future valuation should be.
Precisely. So, to summarize my position, ZSPC is at its core defined by its market mechanics, a uniquely fragile trading environment that was engineered by that 1-for-75 split and made worse by intense dark pool internalization and high short interest costs. For the aggressive trader, this volatility guarantees ZSPC remains a high beta speculative vehicle, one that's liable to sudden violent moves on even tangential news, regardless of what the balance sheet says.
And I maintain that the current persistent depression near 40 cents is fundamentally justified. The price reflects the severe 38% revenue decline, the unsustainable burden of high-interest debt, and that critical looming May 2026 NASDAQ compliance deadline. The software pivot that resulted in that 51.2% gross margin is a necessary green shoot, but until revenue stabilizes and compliance is cured, the stock remains fundamentally a gamble on survival.
The ZSPC story is a unique and challenging one. It represents a powerful intersection where a promising technological future, and we see evidence of that in the gross margin expansion, clashes violently with a very precarious financial and structural present. It really serves as a profound cautionary tale about how capital structure fragility can amplify both positive operational news and catastrophic financial setbacks.
It forces every analyst to confront the tension between that proven gross margin expansion of 51.2%, which validates their necessary software pivot, and the immediate critical threat posed by the regulatory clock. And that tension, the clock counting down to the $35 million MVLS they need by May 2026, that is where the current risk lies, and it is overwhelmingly fundamental.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.